I'm Larry DeBoer. I'm a professor in agricultural economics, and I do the General Economic Outlook. And the U.S. economy is in kind of an interesting situation right now for a couple of reasons. One is that we've essentially reached full employment. The unemployment rate is 4.6%. The economy is pretty close to capacity, and what that means is that further expansion depends on the expansion of resources, of inputs, of labor and machinery and natural resources and that sort of thing. And that will provide now a limit to the rapidity with which the economy can grow. The labor force is growing very slowly, 0.9% over the last couple of years, and that's because the baby boom is retiring. But productivity, output per worker, is growing slower too. And so when you add it up, it looks like the economy ought to be growing by about 1.5% per year, simply based on the growth in resources. Now, if you try to spend more than that, then interesting things begin to happen. And we do think spending will increase more rapidly than that. Consumers are looking pretty confident with wages rising now and job prospects improved and the stock market rising and home values rising, so consumers should try to spend more. Housing construction is likely to increase as well, so spending on houses should increase. And we've got President-elect Trump. And what that means is that fiscal policy is likely to be unbound. We've been in a fiscal policy stalemate for the last 6 years, and so we're likely to see a big tax cut. We might see big increases in infrastructure spending and defense spending, and that will increase the budget deficit, and that will mean an addition to demand. And so here we've got relatively slow growing productivity or slow growing potential output and additional spending. And so if we spend more and the supply is limited, if we demand more and the supply is limited, we can expect increases in inflation, further decreases in the unemployment rate, kind of pushing the envelope on unemployment. So I'm thinking maybe 2.3% inflation. I'm thinking maybe the unemployment rate edging down to about 4.5%. Not much of a change from where we are now, but fairly low. And I think interest rates will start to rise a little more rapidly. I think the Federal Reserve will increase interest rates more frequently next year than they've done at any time in the last 10 years, maybe 3 increases in the federal funds rate. So interest rates will wind up being higher. I think that should increase the exchange value of the dollar. As more people try to lend in the United States and they try to buy dollars in order to do it, and that should inhibit our exports. Our imports might be inhibited if we really do increase tariffs, and that means the volume of trade likely to fall, and it's been falling anyway. So I guess in sum, growth rate may be at 2.3%, somewhere in that neighborhood, as we push the envelope on potential output. Inflation at 2.3%, rising interest rates, rising exchange value of the dollar, and a very interesting situation for 2017.